Hey guys, in this video, we're going to look ahead at some key earnings reports from the week coming up in the stock market. I'm going to take a look at earnings per share and revenue guidance for each of these stocks and give my thoughts on, the current valuations, the future valuations, which one of these stocks I'm looking at investing in or why I wouldn't be looking at investing in them. If you like this type of content, please subscribe to the channel, give me a thumbs up. It really does provide a lot of support for the channel if we get the likes. And then also would love to hear from you in the comments if you have any opinions on any of the stocks that I talk about today or any other stocks in the stock market. Would love to engage with you guys. Okay, so starting on Monday. Monday, there's not a lot of stocks reporting that I'm personally interested in. I've had my eye on the cruise sector. I don't hold any cruise companies, but I've just found the whole space very interesting, especially with the downtrend from COVID, how travel at large has rebounded, but the cruise companies haven't. So I'm going to start looking at Carnival on Monday. If you look at Carnival's stock, just going back a bit, you can see during COVID it went down to low teens, went up on anticipation of a vaccine and so on, but is really like almost as low as it's ever been, despite people cruising again and everything else. So it's a really interesting space. I think ultimately they just loaded up their balance sheets with tons of debt. Fuel prices have gone really high. Some tax situations have changed. CapEx was delayed. All of these things came to fruition, and they're still having a really hard time getting out of it. Now, they are getting a bit more pricing power now. They're at large expected to turn profitable this year. So still a long way to go, but it's interesting because on the valuation front, these stocks are trading still significantly below where they used to be. So used to be at 60, 70 bucks a share here on Carnival, down to 10. Now they released a lot of new shares, a lot of new debt, so their market cap may have not been 6-7 times what it is today because it's more shares out there. But generally, they're still trading at a much bigger discount versus where they were before than even in 2021 and so on. So it's an interesting space to look at. When I look at their earnings for this upcoming year, or at least for the current quarter, we kind of see losses across the board. They're not going to make money. For the current year, you kind of see a very break-even story. Average estimates, they'll lose a couple cents. Low estimates is they'll lose 30 cents. High estimate is they'll make 30 cents. So when you look at that versus the last few years of losing $1.60 in 2022, losing $5 in $1.60 in 2021, losing $5 in 2022, this would be, while this has been slow, a big accomplishment in getting back to where they used to be. If they're truly able to deliver any sort of net income on the year. That's kind of like the first step of growing the business further, expanding their fleet, investing in things that are going to deliver profitable returns and so on. It's really hard to do that when you're just consistently leaking money, especially with the amount of debt and the stock price that these companies are at. It's really hard for them to raise more money in a way that makes sense. So this is one, I like watching it. I'm happy I'm not a shareholder of it. But I'm hoping for the industry that they do end up on the high end of the earnings per share estimates. Would really help, I think, this industry turn itself around. Now, going into Tuesday, I'd say Tuesday is where it's the most names that I'm interested in. You got Walgreens, Lululemon, McCormick, Dave & Buster's, and Jeffries. And that's really the main names I'm looking at. We'll go through Wednesday a bit more, but just going through some of the stocks on Tuesdays here. Walgreens has always been a really interesting, strictly because of the valuation they trade at. They're trading at $32 a share, and they're estimated to make $4.50. So this company is pretty much trading at 7 times earnings. They pay a 6% dividend. I think they're also buying back shares, and they're left with more money to invest in the business. I don't love the business overall. I think it's really competitive to be in healthcare. Retail is really competitive. lots of theft concerns, other issues in some of the states that they operate in, and some of the markets. Hard to retain talent, lots of just input costs going up overall. But all of that has been happening for the last number of years and is somewhat baked into their cost basis. And you're still getting the company at 7 times earnings. So I haven't ever owned Walgreens, but I'll be looking at the earnings report, and maybe it's worth starting a position if this goes under $30 a share. And we're talking about a share price that is trading like 6 times earnings, and I like some of the things that I hear in the report. So this is definitely one that I am very interested in looking at on Tuesday, especially with that 6% dividend. The next company on Tuesday is Lululemon. Lululemon, $40 billion company, is really a phenomenal business, really building its business similar to how Nike did in terms of the space they play, going global, going digital. And they've executed phenomenally, and you can kind of see that over the past 5 years, their compounded growth rate's 50%. So congrats to any long-term Lulu shareholders. What I'm looking at is going forward, looks like they're going to make about $10 a share in 23, $11 a share in 24. So when we just look at their valuation, trading at about 31 times future earnings for 23, and then about 28 times 2024 earnings. And they do have a pretty good growth trajectory. So I get it. I understand why they're trading at such a high valuation, because they've executed so well. And the expectation is they'll continue to execute on the business, and they've deserved that high multiple as a result. But for me, this is one that, while I think it's a great business, they probably have more untapped opportunity to grow. I'm just, with interest rates as high as they are, I'm not really loving the dynamic of paying over 30 times earnings for a company with cash flow yields at 2.5%. I really, really need to have extremely high conviction in the company, and it needs to be more secular in nature, that they'll just grow naturally versus they're going to have to win and fight versus Nike and other companies to obtain that growth. I do like their odds, but I think it's priced in. So this is one that I'm not overly interested in, but it's a great business. I'll be looking at their earnings when they come out. The next one here, McCormick and Company. So this company owns lots of spices. I think they own like Frank's Red Hot Sauce and a bunch of other just like spices that you have in your kitchen. Most people probably have a McCormick product in their house, whether you know it or not. $20 billion company, but this one has actually been on a downtrend. So past 1 year, down 25%. I think if we look longer term, they really just ran up the prior year. So it's interesting to see the ebbs and flows in these companies, but good businesses, as long as they're operating better and better, and they're making good investments, high return on invested capital, over time you'll see it trend up, even though the market may bid a stock up 50% like they did here, and then down 20% and up 10, you know what I mean? But over 3, 4, 5 years, if you kind of see a strong upwards move, you get a sense that the business is being run pretty well. This one's not that straightforward, but I'd say generally McCormick's done a good job over the last 5 years, going from a $50 stock to a $75 stock. I know they've come under some weakness here. At the end of the day, though, similar to Lulu, good business, pretty defensible business, which I like, but I'm not paying 29 times earnings for like a spice and condiments company. I think there's much cheaper options if I wanted a defensible consumer products company, and some that are even higher quality. So this is one that I think it's a good business, good dividend, or at least they pay a dividend, but not one that I'm too interested in. When I look at forward earnings as well, they're going to do $2.50 this year. So they're trading at 29 times forward earnings. So they're not really planning on growing this year on the bottom line, at least, probably some cost pressures. Just seems like an expensive valuation in the market we're in today. Over to Dave & Buster's. So Dave & Buster's has been on a whirlwind during COVID, as you can imagine, going all the way down. Going all the way down from $50 a share, give or take, to $7. and I think they even went below 7 if I remember. I think they were $4 or $5 stock. They've rebounded really nicely here, and in the last 1 year, they're actually down. I thought that they'd be up, but down about 20%. On this one, currently trading 14 times trailing earnings, market cap of 1.7 billion. If we look at their expectations for this year, their expectations is $2.77. So, yeah, that pretty much holds. Looking like they're going to trade about 14 times current year earnings as well, which is, I feel like where a stock like this deserves to be around 12 to 14 times earnings, given the risks with the consumer, given the lack of a moat, I'd say, and lots of other companies providing entertainment type services, really competitive space. Also pretty small market cap, so easy for them to get bullied around. So this is one that I think is probably fairly to, if not slightly, overvalued where it sits today. But I think it can play a role in someone's portfolio if you want exposure to the entertainment space. Some other options here. Oh, these are more restaurants. I thought I'd give you some other good options. And then the last one from Tuesday. I know Tuesday's a busy day, but Jefferies Financial Group. Jefferies is a financial service company that lots of you in the financial space have probably heard of them or their analysts and stuff like that. They are pretty much flat over the last year, give or take. They went on a bit of a run, but now they're back down. They're trading at about 10 times earnings. They pay about a 4% dividend. So gives me like bank vibes in terms of how they're being valued and stuff like that, which I think is generally fair. Looking ahead to the next year, about $3 EPS, and then 2024 it goes to $4.50. So I don't know if there's one-time capex going on, but at $3 it would be trading just under 10 times earnings. At $4.50, this thing would be trading at, what is that, like 7 times earnings? So I'd be interested to learn more about what the driver of this is, the 3 to 450, to see if I actually believe in that. But I think for the next year, this is probably fairly valued in line with, what a typical bank would be in the US as well. Going back to the chart, as I look at Wednesday, Thursday, Friday, the only company on Wednesday, Thursday, Friday that I'm personally interested in is RH, which is a high-end furniture company. They trade at about $5 billion valuation, $240 a share, about 12 times earnings. When I look at forward-looking earnings for this year, this is another interesting one that I'd want to understand. You can kind of see in 24, they're expecting 16, 17, high-end 22, but in 23, their average is 24. So it seems like there's a one-time event in here that I don't understand because I don't own the stock or haven't looked into it in depth. But just looking at 23, the company's trading at about 10 times earnings, but it looks like a lot more downside from the low side analyst. This would be about 13 times earnings versus the medium is closer to the high side. So let's call it like 9 to 13 times earnings, depending on if it's more to the low side or more to the high side. I don't think that's a bad valuation. I believe RH is for like very more expensive, luxurious price point items. When I look at this space, and I sit in Canada, so I also follow the Canadian markets pretty closely. One more local furniture company doesn't play in as high end of a spot, but Leon's is a Canadian furniture retail company. Very similar in terms of how they operate versus RH, even though they go after a very different type of consumer. And this company kind of historically trades 7-8 times earnings, also pays a good dividend, buys back shares, owns some real estate. So whenever I look at stocks in the US, I always try to compare, like, hey, is there a Canadian alternative to this? And just gut check from a valuation standpoint, which one's trading at a better value and so on, and what I think a better deal is. So typically U.S. stocks, if they're bigger companies, $5 billion market cap, maybe a bit more defensible and can weigh out storms a bit more. But generally, I think there's lots of furniture companies that I found, or companies in this area of retail. Think even Williams Sonoma trading at like 8 times earnings, that I can get for an even cheaper valuation that is of similar quality as a business, maybe not playing like exclusively in luxury goods like RH. But I feel like generally this stock is, let's call it fairly valued, but it's nothing that's going to get me to add it to my portfolio at this valuation. So based off of alternatives in similar spaces and home decor and so on, and in Canada and the US and globally, I think RH is an okay company. I think the valuation's okay. So I don't think it's a bad investment necessarily. I think you're making a bet on a certain type of consumer and them having a lot of resilience no matter what the economy throws at them. But overall, not a stock that I'm looking at. So to summarize, out of all these stocks, I'm going to be watching them all. The only one that I'd actually consider buying on a sizable drop, depending on what the report says, would be Walgreens. Pay a great dividend, plays in a relatively defensive space of retail. Not everything I love, not everything about their business I love, but I think it's everything I don't like is priced into the valuation, and then some. So this is one that I'm going to be watching, potentially get on the cheap if it has a good quarter and the stock doesn't move, or it has an okay quarter and the stock goes down badly. So that's kind of what I'm watching this week. Let me know what you guys are watching, if there's any stocks here or not on this list that you're interested in their report this week. And thank you guys for joining this one. If you like this type of content, please hit the thumbs up, subscribe to the channel, let me know in the comments, and I'll see you guys in the next one.